Tom's portfolio app is open. Every single line is red. His thumb is hovering over one button. Sell. War headlines are stacking up on his lock screen. Oil prices are spiking, and every part of him wants to just get out. Missiles, oil shocks, a stock market that's fallen 9% in less than a month. If you were Tom right now, would you sell? Hold that thought. I'm Kellan from Wealth Foundation, and before Tom taps that button, I want to show you exactly what happened next. Let's go. Here's what was flooding Tom's feed. Missile strikes, oil jumping 10% in a single day. The kind of headlines that make anyone's stomach drop. Brent crude jumped to around $80 a barrel almost overnight. The ASX 200, Australia's benchmark share index, fell as much as 9% over less than a month. If your portfolio looked like Tom's right now, down, red, and surrounded by scary headlines, your instinct to want out would be completely human. Most people feel exactly that. But before Tom taps sell, let's actually look at what happened to people who felt exactly this panic before. Because the data tells a very different story than the headlines did. Here's the honest truth about market panics. They feel permanent while you're in them, but they rarely stay that way. Let's look at what actually happened just days after Tom's worst moment. Tom's panic moment, late February. Now watch what happened by the 2nd of March, just days later. On the 2nd of March, just days after the worst of the panic, the ASX 200 closed at a record high. 9,201 points, the highest it had ever been. Investors who stayed in or bought during the panic saw oil and gold stocks surge. Woodside up almost 7%, Santos up almost 7%, gold miners up 5 to 6%, in some cases more. If Tom had sold in that panic moment, he would have locked in his losses right before the market bounced back to an all-time high. But this story isn't over yet. Here's what actually moved, sector by sector. Energy stocks surged over 16% through the worst of the conflict. Defense companies and oil majors overseas jumped too. But not everything went up. Airlines, hotels, and cruise stocks fell sharply as travel outlooks dimmed. And some gold, uranium, and copper miners actually dropped more than 40% at their worst point. Notice something? Even gold, the asset everyone assumes is the safest bet in a crisis, was already showing cracks. And it's about to get more complicated. One day after that record high, the Reserve Bank stepped in. They lifted the cash rate 0.25%, their first hike in over 2 years, specifically because of oil-driven inflation fears. The market dipped slightly the next day. Gold miners, which had just rallied, fell again too. Even in a single week, the story kept shifting under everyone's feet. Now fast forward to late May. The conflict flared up again. Oil jumped even higher this time, over $94 a barrel. And here's the twist nobody expected. The worst performing asset that day wasn't oil or travel stocks or anything obviously risky. It was gold, the safe haven, down 7.4% in a single session. Here's why. Oil spikes push inflation fears up, which pushes interest rates up, which makes gold, which pays no interest at all, less attractive to hold. The safe haven wasn't safe that day. The one sector that stayed calm? Ordinary grocery stores. Think about what that actually means. Energy helped in February, but was flat in May. Gold helped in early March, then crashed in May. Nobody, not even professional investors, reliably picked the right safe asset every single time. The one thing that stayed calm through every single volatile session in this story: ordinary consumer staples. The boring, unglamorous companies selling groceries and household goods. Not because they were exciting, because people buy groceries no matter what's happening in the world. So what actually protects a portfolio through something like this? Not guessing which single asset will save you. Spreading your money across many different sectors and asset classes so no single swing sinks you. It also helps to invest a fixed amount regularly, regardless of what the headlines say that week, called dollar cost averaging. It removes the pressure of trying to time your entries and exits around news you can't predict. And honestly, checking your portfolio every single day during a crisis like this makes emotional decisions more likely, not less. Weekly or monthly check-ins are usually healthier for both your decisions and your stress levels. So, back to Tom, thumb still hovering over that sell button. Knowing everything you now know, what do you think he did? He put the phone down. Not because the headlines got less scary, because he realized panic was never actually his best strategy. Diversification and patience were. His portfolio still moved up and down for months after that, but he never had to relive that thumb on the button moment again. Markets will keep giving you reasons to panic. The question isn't whether scary headlines will come. They always will. It's whether your strategy can survive them without you needing to guess right every time. If this helped, subscribe. Every Monday, Kellan breaks down what's actually happening with your money in plain English. I'm Kellan. Take care of your money because nobody else will.